Hello, everybody. All right, I think I've got all the gadgets working. Happy Monday, May the 26th. I can't believe it's already May the 26th. So, 2025. So, my name is Hung Lu, and I am with Cash Property. We are going to get going with today's episode of Money Matters with your host, Hung Lu. All right, so today's episode is going to be one of those weird things. It's creating a cash flow sheet. And the one that I'm going to show you, I'm not finished yet with it. And I actually started from scratch. And the reason for that is because it's a new program that I'm working on. And it's taken, of course, a bit of time to create it. And that's why I'm going to share it with you because I'm in the process of doing it. And so I want to show you from beginning right now and as I work through it, so it's probably going to be, maybe in another month or two, I'll show you the progress on this particular spreadsheet that I'm working on. So now, before we get into that, if you are local to Vancouver, we have a couple of events that may be of interest to you. So let me see if I can show those to you before we get into the cash flow breakout sheet. All right, here we go. So it's one event, but it's broken into two events on the same night. And so it's this Thursday, May the 20th. First one is an accountability and coaching session with me. Okay, this Thursday. So if you are interested in getting some really cheap, affordable, but high quality coaching, this is one of the things that you can attend. And then after the event, stick around and listen to the Axiom advisors. These guys have a very unique way of helping you raise capital for your next project. Okay, so highly recommended that if you're local to Vancouver to attend these two events. All right. So I will also put that into the chat box as well. Now, if you are watching this on Facebook, please also follow me on YouTube because apparently the algorithms there are different. Subscribe and follow on YouTube. Give the thumbs up, like, yeah, help build that subscription and give me some support. So now, last weekend, I was in Edmonton for a conference, and I just want to say thank you to all of the individuals that I met that actually gave me some positive feedback on money these money matters sessions. You know who you are, so thank you very much for that, because a lot of times I don't get the interaction or the feedback, and I question the time value benefit of this. And so I appreciate the feedback, so thank you for that. So let's get into the calculation sheet here. Okay, so this is a new program that I'm working on, and I'm trying to build out the program out to verify that it's going to be cash flowing for the investors coming in. Okay, this is one of the programs. Okay, so our plan is to start this in January of 2026. So don't let this crazy spreadsheet throw you off. There's a lot of numbers on here because it's a cash flow sheet. I'm building this out so that I can see where the money is coming and going every single month. And this is important to make sure that the program is going to be sound. Okay, so I'm going to just walk through what I can in the next 20 to 30 minutes, and then I'm just going to stop there. So whatever I can show you on this spreadsheet in the next 20 to 30 minutes, that's what I'm going to do. And then maybe in a month's time, I'll show you an update on this spreadsheet and just keep you involved in what's on this program that I'm working on. Okay. So the very first line that I have up here, it's the year and the month. Okay, so I basically just filled this, just created this in Excel. And this is the year for 2025. So I'm going to just move this out of the way. So for the year 2025, so I'm tracking this by year, and I'm going to be building this out for 10 years. Okay, now right now I don't have it going out to 10 years. I have it just going out to 2027 because as I update the formulas, I'm going to update the different cells. And I don't want to build it out for 10 years until I have all the formulas right. So I'm only going out 2027 and updating the formulas just for 2026 and 2027, and then building it out after that. Okay. Now, up at the top, you'll notice that I have these sort of like this bar and then this dot on the top, because what I'm doing is I'm actually grouping it by year. So I have it by month and then I'm grouping it by year. So this is a function within Excel. And the great thing about this is because then I can collapse it and expand it as needed. So my hand motions were wrong there. So I can collapse it or expand it as needed to show the results per year. Okay, so for example, if I click on this one at the top, you can see I basically collapsed it. So I just click on this one here and I was able to collapse the data to show the results per year. And this is important because I'm going to want to see it as it's progressing every single year. So right now I've just got, the 26, 27 year. And then if I click on the 2 button, that will expand it out and show me month by month. Okay. Now, this is a great thing to understand because if you're building this out for, usually I built this out for real estate, you want to be able to show your cash flow in and cash flow out by month. You don't want to just look at it by the year. I see a lot of pro formas come back where they're showing it by year, but the problem with that is that there could be a couple of months within that year where you're negative cash flowing, and you need to make sure that you have money in the bank to cover your overhead, cover your expenses. That's one of the things that I find that's often missing in the active partners spreadsheet is that they don't include enough money to cover their overhead and to pay themselves. And so then they basically starve, for a few months out of the year, which is not a good situation to be in. Okay, so I'm going to expand that out. Okay. So you've got the project team cash injection. So this is the initial cash that myself have to put in to get the project going. We're not going to raise funds from investors yet because we haven't built out the legals. We haven't gotten the MFT. We haven't done the necessary initial setup. Okay. So now ideally, if we have an angel investor, okay, who will come in and inject this. So I'm starting in September of this year, 2025, and I'm saying, okay, in September, we have 150 going in, another 150, and then 50 and 50. This is 400,000. If we can have an angel investor come in for 400,000, that's fantastic. Okay. So whether that's our own cash or an angel investor, that's fine. However, that comes in. So I've put in a formula here for a subtotal. So basically, it's going to take all the numbers that's going across from a range of cells and just giving me a subtotal number. So it works the same as a bunch of cells. Okay. So whatever numbers I put in here, it's going to adjust this subtotal number. So right now we're anticipating 400,000 needed just to start this program. Okay. Now I've got a blue row here for the cash raised inflow. So this is money that we're going to be raising from potential investors coming into this program. Right now I've got $3 million and our target is 10 million. Okay. Now the interesting thing is when I was running this, I started at $1 million. The numbers didn't make any sense. Okay. And I'm going to show you that. So this is one of the first things that I realized was by having this row going across, showing me where the money was coming in from the investors, it allowed me to say, okay, you know what? This program doesn't work unless we have a minimum of 3 million raised. Okay. That was one of the aha moments from just building out the spreadsheet. Okay. So if we had just $1 million coming in or 500,000 coming in, this program does not make any sense. So the benefit of having this spreadsheet is now I can say, okay, you know what? As a minimum, we need $3 million. As a minimum, we need to perform at a certain percentage rate. And so I'll walk you through all that. Okay, so the benefit of doing a cash flow sheet is one, I can see what the minimum requirements are for this project to work. And then the second thing is I can see month by month when I have a negative cash flow situation, which will affect my overall project. Okay, so let's keep going here. Okay, so now I've got a running total, and you're going to see a lot of running totals here because that will affect a lot of the calculations. You can't just look at it by month and be like, okay, well, this month is clean. There's going to be months where we don't do any distributions, or we don't we just carry a positive cash flow in our bank account. And so there's certain things happening, or that we're building up a reserve. So here you can see there's no reserve being built in here. And then all of a sudden we add in $10,000 of cash from somewhere, and then we have no reserve going for a couple of months coming in, but then we added another 10,000 from our cash flow. And so now our reserve running total is going to go up. Okay. So you'll see a lot of these running totals. And so the running total is just basically from the start of the project all the way to a certain time frame. What is the accumulative amount? Okay. And so that is an important number depending on what factor like what amount you're calculating for. Having that running total is actually really important. So we've got a running total for the money coming in. Okay. So that's the project team injection and then the cash raised. And then we have here the investors' cash running total. So that is all of the investors' money coming in, and then there's a running total for that. So I'm separating out the project team money from the investor money, okay? Because I want to make sure that the investors' money coming in is used for their return on investment calculation. I don't want to take our project team money, which in this case is going to be 40,000. I don't want to use that as part of the ROI number because it's not. Okay. The investor cash coming in, which in this case here is the 3 million, that is going to be what's used for their ROI number, not the 3.4 million. Okay. So then the funds that are going to go into the investment vehicle, which is what this whole program is really going to be what is the amount of money that the investors put in, less any distributions, less any overhead, less any fees, blah, 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 blah. Okay. So this number is going to be different than the money that's coming in from the investors. So the first number you'll see, well, it's the same, but as time goes on, that amount will change. And so you can see that over here. Okay, like the investor money coming in is 3.5 million, but then the funds that we have available to invest in the program is 3.575, right? And there's some additional stuff that we were able to benefit from to increase the amount that we're going to be investing. Okay, so then we've got a performance amount here. So this was the extra thing that I found out. Okay, I'm going to delete some of these comments here. So what I did was I copy and paste cells to make it easier for the formatting and stuff. But of course, that's not the correct comment. So then I have to go back and delete those. All right, so here I'm running an example saying, okay, you know what? Our program performance is going to be 2.5% for that month. Okay, how realistic is it? Okay, so if I go over here to the end of 2026, okay, I've basically taken the sum of the 2.5 from every single month, which is a subtotal number here. And I'm just saying, okay, from this range of returns, what's our subtotal? So a 30% return for that year, that is an actual realistic number that we've seen from our historical data. Okay, and that's what I'm actually targeting. And right now we're actually seeing way higher than this 30% a year. So this is 30% a year. So I'm going to delete that comment because that doesn't apply anymore. Okay, so this 30% is what we've seen historically from data from 2.5 years of data. Okay, and right now for the last 5 months, we've actually seen that return per month, which is insane. So at a 2.5% return, okay, I'm just going to leave it at 2.5 and show you the effect of what what happens to the spreadsheet. Okay. So based on a 2.5% return, our performance, and this is just a calculation of the amount of money that we put into the program to run. So this 3 million. So that translates to $75,000 in profit. Okay, so the running total for that profit coming into the program is 75,000. And then I've got a line here. So this is a target saying, hey, you know what? Did we meet a certain target? And if we did, then we can withdraw some of the cash out to do distributions. If we don't meet a target profit, then we don't touch the okay. So I've got a target met for withdrawal here. And there's a bunch of no's going across here because basically I've put in a formula that says, hey, if we've met the target, then we can take money out. If we have not met the target, we don't take the money out. Okay. So here we basically don't take any money out. Like the answer is no. Okay. Have we met the target? No. Okay. So it's one of those really easy way of setting up your spreadsheet for cash flow to make sure like, hey, you know what, is there an error here? It has the condition met for me to do A? Has the condition been met for me to do B? Okay, so in this case, we have a bunch of no's going across here. Okay, so this really sucks. Okay, so basically now what that means is we're not allowed to withdraw any money. So the amount to withdraw for investor payout, we're not taking any money out. So I already know that this program is not going to be viable at this rate. Okay. So basically then we don't even withdraw money for a reserve. Like there's no money to come out for a reserve. So I'm going to put 0 there and I'm going to put a 0 here. So the reserve is a manual number input. Okay. And so if you're building something like this out for real estate, you definitely want to have a reserve for rentals and stuff like that. So in this particular case, the reserve isn't for rentals. The reserve is to make sure that we have money to cover our overhead, to make sure we have money to cover our legals, to make sure that we have money to pay the managing partners. And in this case, we don't have enough money for any pullouts at all, right? So I'm going to go back in here and withdraw that. Okay. So now I've got in here a management fee, performance fee, overhead fee, the MFT. Okay. And the MFT is just a mutual fund trust. So there's a cost to setting that up, which is why the team needed to come in with 400,000. So usually here you'll see a management fee of 3%, 5%, 1% would be amazing. So right now I've got a placeholder here of 1% for management fee, 1% for performance fee, and a 1% for overhead. So a total of 3%. Okay. So where does that money come from? Well, it comes from the injection of capital raise to manage this. Okay. So you can see there's $90,000 that goes to management fees. Okay. This is massive. Okay. And at this point, we haven't justified paying $90,000. So this program right now does not work. Okay. And I can see that because there's 90,000 going out. Okay. We haven't seen enough money coming in for us to withdraw. And so I'm just going to go down here to show you this yellow line here because I've got a line in here showing return to investors. Look at this. 0%. Okay. And there's a 0% calculation here because our target is to do quarterly distributions. Okay, so there's March, June. When is the next distribution here? September, and then probably in December, right? Yeah, so in December. So wherever I've got these cells highlighted, okay, look at this. The return to the investor right now is 0. So there's that doesn't work. Okay, so now let's just say we go up here and we see a return of 5%. Okay. And we're going to go across the board and we're going to say 5%. So I'm going to just copy this going all the way across and we're able to achieve 5% per month. Okay. That's a 60% return per year. Okay. If we could do that, that's amazing. Okay. Because usually for real estate, you know what, we're targeting 20% private lending 12 to 15, 17%, right? So if we can get 60%, that's pretty amazing. Okay, so now right now on my program, I'm seeing 30% per month minimum already. So this 5%, I would say I'm very confident with my own money, okay, to be able to do this. Okay, so now at 5%, are we able to withdraw any money yet? So we're saying no, going across the board, but look at this. By the time June comes, we are able to withdraw some money. Okay, so now in June, let's say here, we're able to withdraw, target met for withdrawal, we're able to withdraw 735,000. Our performance here is 800,000. Okay, so what I've based, so to calculate the 735, I basically just took my 15% times my running total on the investment. Okay, so I've got 4.9 million of capital invested from various investors. From that 4.9, we've made 5% on that money, month over month over month. Okay, so our performance here just for that 1 month is 250. So now you add up all the performances from the previous month. Okay, and that will give you your roughly about 845. So you see, that's why I do my running totals. Okay, and the running total, basically, I'm just adding up all of the performances going forward. Okay, so let me just double check here. Yeah, see, so I've got a running total. So I basically take, oh, I see. Okay, so I've actually included a withdrawal amount here, which I wouldn't, we wouldn't be able to do any withdrawals here because there's no money. Okay, so this number here has to be adjusted here as well. So amount to withdraw for the investors. So what we're saying here is that we're actually going to take some money out every single month because we have overhead costs. Okay, so here what we're doing is in June, we are able to take some money out for investor payouts. So we've got about 700,000 that we can take out. So let's just say we take out 700,000. Okay, so 700,000. Okay, so our total withdrawal for that 1 month is 850,000. Okay, so we would, okay. So now what that tells me now is down at the bottom, I've set up my spreadsheet that we're able to pay the investors, cash to distribute to the investors. Okay, so each of the investors, depending on get a pref. Okay, so it looks like I'm going to go through that next time on showing you how that pref calculation works. And then after the pref, we still have 528,000 to distribute after the pref. Then there's a set amount that would go to the investors and then the total payout to the investors. Okay, so at this point, I'm calculating out and I'm getting a 10% return to the investor at this time frame. Okay, and this number is based on saying, okay, to the investors, we've paid out 488,000 and they've invested that $4 million. Okay, so it's a snapshot in time saying, okay, Mr. Investor, you've come in, or a group of people have come in, we've distributed 488,000 and you've put in 4.9 million. So your return on your money as of this point is 10.9%. So now this is a snapshot in time. So this spreadsheet needs to be updated because we need to calculate it by annum. Okay, so this would be for the total time frame. Yeah, so I'd have to update this. I have to figure this part out because this would be a snapshot in time, right? Snapshot. Oh, spelled that wrong. In time. Okay. So as you can see, this is a very elaborate spreadsheet and it will take me a little bit more time, a lot more time to build this out. Okay, so I'm going to stop there because that is 30 minutes. So if you are in the if you are in Vancouver, sorry, I'm still stuck on last week. All right. If you are in Vancouver, come and follow us with the Axiom Advisors and the accountability and coaching session this Thursday. All right, everybody. Thank you so very much for watching and have a fabulous week.